Some important warnings about jumping on the commercial real estate bandwagon right now. Hi, Ken Wade here. You usually hear me talking about residential real estate markets. This time we're focusing on commercial real estate and what you need to watch out for. You may not know this, but I was a commercial real estate expert long before I was a market timing expert. I've done more with commercial real estate than probably any other so-called guru out there. If you're thinking about getting into this program or getting into commercial real estate, you need to watch this short video right now before you do anything. It's true, commercial real estate is in deep doo-doo right now, and it'll get worse before it gets better. Here's why. Commercial real estate is getting hit on 3 levels simultaneously. You got rising vacancy rates, rising cap rates, and the limited access to capital. The net effect of this triple whammy is a death spiral in commercial real estate valuations. It couldn't come at a worse time because most commercial mortgages are short-term, 5 to 7 year maturities, and most were refinanced during the 04 to 06 mortgage boom. It's important you understand the problem before you jump into commercial real estate with both feet. You can see here mortgages held by commercial banks skyrocketed from about $400 billion to $1.3 trillion by the end of 06. Banks were loaning money like they were printing it. Thousands of ill-conceived and ill-timed real estate development projects got approved and funded thanks to Wall Street's commercial mortgage-backed securities program, or what's known as CMBS. After 06, the bottom started falling out. The CMBS market dried up and disappeared. Where once there was surplus liquidity, now there's none. The commercial real estate crash is happening in slow motion. For all practical purposes, there's no secondary mortgage market outside the U.S. government anymore. It used to be that the banks could make and package commercial mortgages, sell them to Wall Street, make nice fees, and be done with it. Wall Street would slice and dice those mortgages into tranches, or parts, and sell those parts to institutions and sovereign funds all around the world. In other words, there was a big liquid market for these loans. Banks would offload them in a heartbeat. Those days are gone. No one wants or even trusts those securitized mortgages anymore. It was a game of musical chairs, except the banks got stuck without a chair once the music stopped. Now they're holding all those mortgages. And now they're teetering on failure themselves. So they've got no choice but to look the other way. As long as the debt service payments are being made by the property owner, they don't need to reserve against them. But the day of reckoning comes when it's time to refinance, and valuations just aren't there to support those same loan amounts. That creates big risks along with big opportunity for you. It'll unfold over the next couple years. Get ready, but be patient. There will be huge money made, but you've got to time your move perfectly. 3 important warnings. Number 1, just because banks and borrowers will be dumping those loans and properties, it does not mean you should be backing up the truck to load up. Number 2, you better have either the marketing, operational, or capital sourcing skills to add value to these projects. And number 3, timing is everything. Get the local market timing wrong, it'll be like living in hell. I'll help you in all those areas. Follow the directions right under this video. If you're not watching this video at the Housing Alerts blog, you should go to housingalerts.com/news right now and get the full scoop. Here are some important big picture facts you need to know before we close out this video. Commercial real estate values are still in a free fall. Nationwide, they're down 40% in 2.5 years. Now that's all property types combined. But that's a monster move down. A crash of that magnitude in such a short time doesn't automatically spell immediate opportunity. You gotta let it bottom, or you'll be another casualty. The smart money isn't rushing in yet. They're giving it time to see what flushes out. That's the best part. You've got time to do it right, while others are absorbing all those ongoing losses. Don't be fooled into believing the train has left the station. It's just now starting to board passengers. Pick your time, your market, and your property types very carefully. Now is the best time to get started. You've got a lot to learn. When you're dealing with big numbers and little capital, you've got no margin for error, no matter what others may be telling you. Okay, let's take a look into some of the various submarkets. The office building market has been the hardest hit so far. Remember, these are overall average declines for the office building sector nationwide. But nationwide, they're down 41%. What's happening locally is all you really care about because you don't or you can't invest in a national average. Local market timing is the key to your success in commercial real estate, and I'll help you crack that code. Take a look at retail. Shopping centers, strip malls. In general, retail buildings have lost 31% of their value in less than 3 years. Now, I personally expect retail space will be the last to turn around, and it's at most risk of further, deeper declines. Retail is something I specialize in and have seen many a newbie get crushed in this sector. It's also a sector that, in many markets, is the most overbuilt. Don't buy a half-empty strip mall thinking you have the ability and the skills to rent it up unless you're an expert in that sub-niche. On all these charts I'm showing you, do you see any sign of a bottom or a bounce? I don't either. Now, when it does come, that's when you get aggressive. And we'll be some of the first to know. And markets do matter, far more than any specific strategy or tactic. Let's take a look at apartment buildings. Overall, they've lost 33% of their value in that same 2.5-year period. Now, there have been a lot of multi-unit experts with long successful track records losing their properties to foreclosure even before their loan matures. They aren't even cash flowing. Long-term vacancy rates for housing units of all kinds have been creeping up nationally for many years. The excess supply of single-family homes, whose vacancy rates are also climbing, adds an additional layer of long-term turnaround risk. The important takeaway from these slides is that the commercial market as a whole, and by sector, is still in a free fall when viewed as a national average. Some local markets will buck that trend, but generally, you don't want to do anything but transactional income opportunities until that changes. But recognize, even transactional deals are harder to do and take on more risk if the market is still tanking. I mean, some quick flips can always be done, but it's nothing like doing those same deals when the market is bounced. Now, this isn't meant to scare you. It's a wake-up call, offsetting a lot of what you may be hearing. I do believe commercial real estate is a great way to invest, especially with the opportunity heading our way. You need to invest some time learning commercial real estate now. It's a much different ballgame than residential, and you've got a much higher caliber of person sitting across the negotiating table from you.